Well, good morning, everyone. Thomas Montgomery. It's a beautiful Monday morning. Today is Monday, April 6th, 2026. We get together most weekday mornings at this time. The purpose of our gathering is really twofold. It's to gather individuals that are looking to raise capital to start or grow a business, to explain a new grant program that might be of assistance to them. And then secondly, we have a group of constituents who are looking to get paid to help people do that. So regardless of which side of the equation you're on, I want to spend just a few minutes not trying to sell you on anything or convince you of anything, but to cover how this grant subsidized program works so you can make an educated decision if you would like to participate. At any time, you have any questions, comments, concerns, type those into the Q&A and we'll get to those. So in the background, we have our website, spefunding.com, and that's a really important resource because when we applied for and received the grant, transparency was of the utmost importance. So if you go to spefunding.com and scroll down, you'll see that there's a three-step sequence to be able to participate. The first two steps provide really an in-depth training going much deeper than what we can do just in a few minutes in these morning Zooms. And then thirdly is the ability to actually participate if you would like. It's very easy to participate. It's designed with no risk and there's no upfront cost. While the program is not free, it's subsidized by the grant and the costs that are incurred are financed. But with that being said, let's focus on our topic today, which is a legal loophole, how anyone can get a large business loan. I think you and I would agree there are a lot of people out there that want money, that need money. And at the same time, there's a lot of banks, credit unions, and alternative lenders. So one might ask, well, where's the problem? If we have lenders and interested lenders and interested borrowers, why aren't they all just getting together and you and I could just be having breakfast right now rather than being on this Zoom? Well, the problem is most small business owners are not qualified. They won't get approved if they do apply, or if they do apply, they get declined. So that's what we hope to do is to build financial literacy of what is it that you really need, and then what are some ways that you could accomplish that. So let's go ahead and get started. And I'll go ahead and maximize this page for us. So we believe that getting a business loan shouldn't be difficult. No different than getting a mortgage for a home or a car loan for an automobile. We need to qualify for whatever we're applying for, and that's a big problem. A lot of people, they don't know how to meet the qualification requirements of a business loan. So we're going to explain in general what those qualification requirements are and show everyone a legal loophole how anyone can qualify. Not too good to be true, not smoke and mirrors, but we'll go through that and you can tell me your feedback as we continue. So, if we want business funding, we need to have a fundable business. Pretty simple statement, but it's huge. There's a lot of people that want business funding, but many of them, I would argue most of them, do not have a fundable business. So we have an inconsistency between where they're at and what they want. What you and I can do if you decide to become one of our distribution partners is resolve that problem, help everyone have a fundable business. Not too good to be true, not smoke and mirrors, but we're going to go through that now. Now you might ask, well, what does that mean, right? And like, sure, okay, give me a fundable business. Worse yet, some people will just say, oh yeah, I have a fundable business. So then when we follow up and ask some probing questions, often we realize they don't. So in many cases, it's a lack of financial literacy. They don't even understand what that means, let alone do they actually have it. So that's what we're going to resolve today. We're going to walk away in a few minutes and everyone will understand what it means to have a fundable business and some options to get that so we can go to funding in 30 days or less. So, simply put, no surprise, a fundable business means that it has the credibility elements required by the lenders. It has what it takes to get approved. Not too good to be true, but we need to understand what lenders are typically looking for normal, larger business loans. So the first thing that a lender is going to look for is, does the client, does the applicant, does the prospective borrower have a good compliant business entity? Now, that doesn't mean that it has to be over 2 years old or over 5 years old, but is it in good standing? Is that S Corp, C Corp, LLC? Is it in good standing at the state and federal level? Not a real difficult accomplishment to obtain, but it is an important element. We realize that, so we actually provide a compliant business entity through the grant, but we'll get to that in a moment. The second of the three elements in describing a fundable business is the loan package. Now, this may sound kind of Greek to you. And again, just don't fall of that mindset. Oh, I don't understand this, so it doesn't matter. Just get me funding. We can't ignore the truth. The truth is we do need a business entity that's in good standing, easy to accomplish. We also need the paperwork. Now, what each lender may request can vary somewhat, but in general, we're going to need to present to the lender a business plan, which we provide, financial projections normally going out 36 months, 3 years, which we provide, and also feasibility data. And this is one that a lot of people want to quickly dismiss. It's like, I don't need that. Just give me the money. But lenders don't know as much about your business normally as you do. And so feasibility data is referred to as that third party objective information that essentially justifies what we're saying over here. So through the grant, we provide all of this as well as the entity. Now, I wish it were so easy that if we just had numbers one and two that we're good to go. But there's actually a third element that is mission critical, and we refer to it affectionately as the three C's. It's essentially assessing the credibility of the applicant, and that's normally looked at by measuring the three C's: the creditworthiness, the collateral, and the capacity. Now, if you're quick to say, well, I don't have these things, this isn't going to work, I won't get a loan, you're missing the point. The first thing that we're attempting to establish is, what do lenders look for loan approval? But we're also going to talk about a legal loophole where anyone can have that. So don't become disappointed, dismayed, or disconnected because you don't have all of this in place. That's in fact what the grant provides. That's why we're here to discuss it today. So with the three C's, creditworthiness is the first of the three C's, and there are two elements of creditworthiness: business creditworthiness and business owner creditworthiness. So what we do through the grant is we build the creditworthiness of that business entity that we talked about. And with that, we're going to build up the paydex score, add trade lines. And we're talking about real trade lines, real usable trade lines. Company cars are our favorite, but not everyone wants a company car. We can get company credit cards, other trade lines that are real, they're usable and valuable. But by having those payment experiences under the business, under the EIN, that shows that the business is creditworthy. And then the business owner often is an important variable. We don't necessarily focus much any longer on building business owner credibility. Instead, if there are credit issues with the business owner that's participating in the grant, we have a co-signer program where we'll just provide a co-signer rather than trying to help someone improve their credit profile. So creditworthiness is the first of the three C's, and then collateral. Collateral are the assets that's pledged to the lender, that in case we don't pay back the loan, that the lender has something to mitigate their risk. And then the third and final C is capacity, probably the most difficult to understand of the three. So the capacity is where we're demonstrating, we're showing, we're illustrating to the lender that we can afford to pay the loan back. That's partially accomplished through our future projections, but often they also want to see where are we now? Do we have enough money coming in now? So some people say, well, if my company's pre-revenue, in other words, not making any money yet, I can't get a loan. That's not true. So capacity can be demonstrated forward looking with projections, but we have some innovative ways to build capacity even for a non-revenue generating business. Beyond all of this, there are a few other variables that you should be aware of, one of which is the industry. So, depending upon what industry our business is, which was number one, based upon how the business plan is written, can affect funding how we're going to use the money. I know a lot of our clients would prefer that they just state some dollar amount and just get funded from the bank. But the bank's going to want to know a little bit more about how do you plan to use those funds. Are we going to use it to buy real estate? Are we going to use it to acquire an existing business? Are we going to use it to buy equipment? Do we just simply need working capital, just cash? We need to understand that and be able to convey that to the lender in the business plan. And then there's going to be some constraints around that. And then, of course, the three C's. So, as you would expect, the larger the business loan, the stronger our three C's need to be. But I need to pause for a moment and ask the questions from those of you. We have 634 of you on this morning. Does anyone, and we're not talking about our grant or the SPE program, SPE funded. We're just talking about what it takes to have a fundable business. Does anyone have questions thus far on this point of the discussion? Because it's important that we understand. We may already have it, we may have some elements, or we might not have any or not much of it. That's not going to be a problem. I'll show you in a moment how we can provide all of that through a couple different strategies. But we do need to understand what lenders are looking for. Sometimes we'll have clients that come to us, grant participants, and they're like, well, I need to go to funding today. Okay, great. What is it that you qualify for today? This represents what we would need for a normal large business loan. But what's true is that there's some other alternative financing that we could accomplish with just a subset of this. So it's not an all or nothing in terms of we can often get some interim financing based upon where the client is now. And in fact, that's the first thing we do. When someone participates in the grant, we get them financing offers normally within 1 to 2 business days of them enrolling in the grant. Does that mean that they're going to qualify for a real large amount? Usually not, because normally they need help with these elements. However, we can often get people their first tranche, their first round right away. Any questions on what it takes to have a fundable business? Okay. So we look at this and it may seem like a problem. It's like, well, that's well laid out, but I don't have this. So is this not going to work for me? Well, now we're going to spend a few minutes talking about how we can legally get this very quickly in some ways that might surprise you. It might not have been what you considered before. So that comes down to the buy versus build. So in business, a common scenario is, I have a problem, I need a solution. Do I want to build my solution? In other words, create it myself. Or do I want to buy? Do I want to acquire a solution that is already built for me? So with that, that's the first decision that a client needs to make or a grant participant, anyone looking for funding, in fact. If we agree on what it takes to have a fundable business, and none of you had an argument on this, and I think this is factual, and if we determine we don't have all of this, so the question next is, do I want to buy a solution or do I want to build a solution? Do I want to build my business to be fundable based upon what we've discussed? So the build versus buy. Build is what most people have historically done. It's like, well, I need funding. I don't have all these elements. Let me get to work. And that can be a really long journey. And just look at collateral alone. If you don't have enough collateral to qualify for the loan and it's a requirement, how long is it going to take someone to get that collateral put together? It could take a long time. Or if someone doesn't have the capacity to be able to show the lender that they can afford it, how are they going to accomplish that if they don't have the money they need to generate the cash flow? So the build is possible, but it can be a longer journey with an undetermined completion date. What we're here to promote, encourage, whether you're working with us in our grant or not, is to not do a build, but instead do a buy. We believe this is a much better option because we can generate immediate cash flow and have a fundable business normally in about 30 days. So the buy is what we probably need to be focused on. That's not what most people think. Most people default to the build. I think that's a mistake. Unless they're very, very close already with all of this, I don't think the build is the right choice. So what we're going to do is talk about ways to be able to fulfill this buy and give you some new information you may not have considered before. So essentially, if we want to get business funding and we know we need a fundable business, as we've described, we could go buy a business that's fundable. The local grocery store, the local gas station, a doctor's office, a dentist's office, the auto mechanic, doesn't really matter of the industry so much, but there are businesses for sale, and you can find some of them. We're not related to this website, but on Biz Buy Sell, you can see businesses that are for sale. So theoretically, we could go get one of these businesses that's for sale. In other words, we're going to buy a business, and then we could turn around and use that acquired business to get funding because we can ensure that we're only going to buy a business that has this in place. That makes sense. But the problem with that is we have to have enough money to go buy that existing business, and that could be costly. So that's really where the rubber hits the road with our grant and the SPE is we have innovated a unique way to buy a fundable business that doesn't require any out-of-pocket cost so we can provide the grant participant the elements of a fundable business so we can go to business funding. So let's dig into what an SPE is. Anyone have questions so far on what we've covered? Okay, let's move on. So what is an SPE? What is the SPE model? So SPE stands for a special purpose entity. So let's say that we were going to go buy the local gas station and use that to go turn around and have the credibility elements to get a loan. Does that mean that our goal in life was to own a gas station? Not that there's anything wrong with it, but no, we were using the gas station as a means to an end. It's an open business, it's making money each month, plus it gives us what we need to go get the big business loan. Well, the SPE is similar in the sense that a special purpose entity, sometimes called a special purpose vehicle, is meant to go get the capital raise. And then it can be operated or it doesn't have to be operated, which we'll talk more about in a moment. But it's meant to be a separate entity, isolating financial risk that we can go use for funding. So it's not meant to replace our primary goals and aspirations, but it's the vehicle in which that we accomplish it. As I mentioned before, the way that the grant is set up, we're able to provide special purpose entities with no out-of-pocket cost. Now, again, not saying it's free, it's subsidized, but it's not free. But it's a $5,000 deposit to get started. And no, people don't have to come up with $5,000. We can facilitate financing for that. What's great is just like buying that local gas station, if you were to go buy that gas station, the gas station has clients. The gas station is making money. So not only could we use that gas station to go get funding because it has these elements, we'll make money right away. The SPE is innovative that it does that as well. So the SPE comes with $250,000 in first month income. How that happens is not too good to be true. We transfer 25 contracted clients over that month, normally 6 per week till the fourth week, 7 in the fourth week. So all of these are real clients that now owes the SPE. And when they pay the SPE that creates the cash flow. So it's kind of like buying the gas station, right? There's already people coming to buy gas. So now when they buy gas, they're paying your business, your gas station. Here, the way that we set up the SPE, we transfer clients so you have first month income to help substantiate the capacity. So then, in addition to getting the SPE with no out-of-pocket cost and first month income, again, we can go use it to get funding because that's a real goal, right? What we're trying to address today is how anyone can get a large business loan. There are certain criteria, elements that are needed. If we don't have it, we can buy or build our solution. If we're going to buy a solution, we can go buy a traditional business or we could use the SPE, which is going to be a more practical solution for most people. The SPE model provides those elements that we talked about above, and it's a real business, right? Because you can't take a non-real business, whatever that means, and go get funding. That doesn't make sense. So it's not a gas station, it's not a grocery store, but we set them up as management consulting businesses. It's really what they are. It's truly a management consulting business. When we transfer an SPE to the grant participant, which is highlighted here, they can either run the business or not. So take Gilbert, who's on here, and Gilbert's on almost every morning. He's one of the more successful people that I've ever met. So Mr. Perez could go buy that gas station and he can just close it down. He could buy it, close it down, but if it has the credibility elements, he could still use that gas station to get the loan. But if Mr. Perez did that, we'd all look at him and say, dude, you just bought a gas station. Why are you not making money from it in addition to using it to get a loan? So the management consulting business, it's designed to be operated, but people don't have to use it, don't have to operate it if they don't want to. It's not a prerequisite. But it is designed to provide the immediate income as well as the capital raise. Now, the capital raise is guaranteed. We put that in writing. If you follow our model, our plan, we guarantee that it'll work. Here's the downside of all of this, because I don't think anything is perfect. The downside is the way that we set the SPEs up. Yes, we're going to have first month income. Yes, we're going to get a guaranteed capital raise, but that guaranteed capital raise is only promised to be 250,000, and that's not enough for some people. So you might ask why? Well, why is it only 250? Well, remember we talked earlier and we said one of the constraints would be the industry code. So if we set these up, which we do as a management consulting firm, to create a reasonable use of funds for that industry code, it's frankly only really got borrowing capacity for $250,000, 250,000. So what do we do if we need more than 250,000? Two options. We could either change the industry code to something that would warrant a higher loan amount, a different use of funds, or we could repeat the process multiple times. But that's an important constraint you need to be aware of. So I'll answer what now, and then we're going to spend the rest of the time answering the questions, comments, concerns that each of you have. So if your goal is to get money to start or grow a business, then I would encourage you to go to SPE funding. I showed you that website at the beginning. There's the 3 steps at the bottom. Frankly, you could go right to the 3rd step to participate in the grant if you wanted, but steps 1 and 2 will give you more in-depth knowledge, but that's where you would go if that's your goal. In contrast, you can come over here and go to Opportunity Fund if you wish. And with the opportunityfund.info, that's where we're going to be able to assist you in becoming a distribution partner. So who has questions, comments, concerns about the model? Anyone have questions, comments, or concerns about the model? All right. Well, KE has a really good question, and let me minimize this down so we can see it navigate. KE's question is a common one we get. Why would someone, what KE's asking is, why would someone not want to do this? Well, if you don't need funding, then of course you wouldn't need to do this. If you need funding, but you already have a fundable business, then you wouldn't need to do this. But otherwise, I think it's a really strong consideration. Thank you for that, KE. All right, Kenneth, and we get several Kenneths on. Kenneth is asking about what's it going to cost him to get a capital raise? Well, that's a little bit of a complicated question, but let's break it down. Well, if we're going to go borrow money, we want a large business loan, you would have repayment terms, and the lender sets those repayment terms. Normally, when we're doing a large business loan, it's normally financed over 10 years, 120 months. That's the norm. So you could take the amount, Kenneth, that you're wanting to borrow, divide it by 120, and that would give you your monthly principal payments. So we need to budget for that, right? But we are going to build that into the financial projections. And if in fact, whatever you're planning to do with the money isn't going to generate enough cash to pay the bill each month, you probably wouldn't want to borrow the money. The second would be we do anticipate there being interest cost, right? So lenders want to be paid an interest uh, amount on top of loaning the money, and you're going to qualify for market rate interest. So each month we'll have a monthly payment to the lender that is the principal and interest. How much the interest is will vary by lender, vary by loan approval. Client always approves that. Normally it's around prime rate. As far as other costs, it depends what your approach is. You know, if you're going to use the buy option, what's it going to cost you to buy a fundable business? Well, if you're going to go buy a gas station or a grocery store, go to Biz Buy Sell or go to whatever the entity is and make an offer, and whatever you agree to pay for that business is your acquisition cost. That could be from little to lot. If we're going to do the SPE, again, we do have a $5,000 deposit. Doesn't have to be paid out of pocket. We set up financing for that. Everyone's approved for financing. We have different financing options. But to get started with the SPE, I mean, you're still going to have the loan, right? We're not paying your loan payment each month, and that's not what Kenneth is assuming. But to get started with the SPE, you are looking at paying the deposit, but the deposit can be financed, and we have financing for everyone. In other words, no one gets declined for financing. KE has a follow-up question, time frame for funding. That's a good question. So those are the main questions people ask. Like, Kenneth, what's it going to cost me? And the deposit's 5,000, but paid out of financing. And then but there's other cost for a capital raise, of course. And then KE came back and asked, well, how long? Well, it depends, right? So if you already have a fundable business, KE, we can go today and apply for funding today. If you don't have a fundable business, then we have to decide buy or build. If we're going to build, which we can help you with, but I don't know how long that'll take because we're counting on you to bring these elements. If you're going to buy, then we got to decide, are you going to buy an SPE, which has a 5,000 deposit, which can be financed, or do you want to go buy another existing business? So we're going to have all of this in place to get a business loan. But the time frame he's really asking is for the SPE. So in the first month, so from day 0 to the end of the month, day 30, day 31, we will have anticipated that you will have generated 250,000 in first month income. Then, once we've done that, now we've demonstrated the capacity, which is the last of the 3 Cs. So then we can go apply for the business loan immediately thereafter. So I know it's not the answer that KE wants, but that's technically the answer. In the first month, you'd be looking at 250,000. Then in the second month, we can go apply for the loan, and the loan guaranteed amount is 250,000. So technically, you're looking at 500,000, but that wasn't his question. A pessimist might say, well, why don't we go ahead and just go to funding right away? Well, yeah, as soon as we have a fundable business, we can get the entity to an SPE participant near immediately. We can build out the loan package very quickly. We need a little bit of time to get the trade lines added, but we can get at least the paydex score, the Dun and Bradstreet profile established at least in that 30 days. We can transfer the collateral over within that 30-day period, which we promised to do. And then the capacity is multifaceted. We can have the financial projections done in less than a month. We can transfer those 25 client agreements over the course of the month. And so essentially, if we're transferring the 25 client agreements over, that's generating that first month income. If that's happening during the first month, then that would need to elapse before we go apply for funding. So our normal model would be to get the client the 250 from the client transfers in month one, and then immediately thereafter go to funding in month two. Did that answer your question, KE? Aziz talks about branch office income, and that's a good point. So there are two ways that you can generate income through what we call the branch office or the management consulting firm. All means the same that we've talked about here. So number one is we're transferring the 25 clients over to you. So some of you, well, many of you, well, all participants had a transfer over this weekend. So take Diamond, who's on here. Diamond's a real person, a wonderful entrepreneur. We transferred to Diamond, if I recall, 8 times 6 is 40. We transferred 96 clients to Diamond over the weekend, each worth at least 10,000. We transferred $960,000 to Diamond. She's doing 8 SPEs over the weekend. Matter of fact, all of you that are already using the model, you have received a transfer over the weekend. Usually each weekend is when we're transferring those client accounts. So that's the first source of income. And then the second is if you want to actually operate the business. Now, Diamond is an expert marketer. And if I understand correctly, Diamond, don't let me misrepresent, but Diamond is planning on bringing on her own 50 to 70 clients in the month of April. I believe that's correct. Hopefully, that's not a misrepresentation. So, in addition to the client agreements we're transferring to Diamond, she's also planning on bringing 50 to 70. So, that's additional capacity coming in. Aziz, that's what you need to do, right? You need to get if you're wanting to participate, what do you need to do? You need to come over here to spefunding.com, go through the 3 steps, or at least do the third step. That's the enrollment. You need to pay for the deposit. It's 5,000. You don't have to pay for it out of pocket. We have guaranteed financing for that. I don't think you've done those things, Aziz. So until you've done that, of course, you're not seeing the results, the deliverables. All right. KE's asking as far as paying for the SPE. So with the SPE, there's 2 components. There's the deposit, which we've talked about 3 or 4 times. It's a $5,000 deposit, and it is paid out of financing. You can pay it out of pocket, but you don't have to. And then once we go from the deposit, we put together the feasibility study, which we talked about up here, the data, and then confirm that we're ready to move forward using this concept of a management consulting business. And if so, then we go into the second stage, which we call the license. The license is what provides us the ability to provide you the 3 C's. There's more to it than that, but is in gist. So once, and the license again is paid for out of financing, not paid out of pocket. So we can move forward very quickly at any time if the client decides that they don't want to do the buy. We can work with them on the build, but hopefully they answer your question. If you have individual questions, you can let us know separately. All right, well, let's wrap it up from there. We covered a legal loophole, how anyone can get a large business loan. Didn't try to sell you on anything, didn't try to brainwash you, but what we wanted to do is to establish what do lenders look for, two ways that a potential borrower can go about getting this, buy or build. We talked about some different options to buy other than just going and getting a traditional business, one of which is called the SPE. We clarified that the SPE, again, there's more information on spefunding.com, is a great way to have a fundable business that generates income as soon as the first month and also qualifies for a guaranteed business loan. If you want to be a participant, spefunding.com. If you want to be a distribution partner, hop over to opportunityfund.info. Thanks, everyone. We'll be back tomorrow morning. You're welcome to come back and join us or even bring a guest if you'd like. Have a great day. Thank you. Bye.